Angel is brought to you by NetSuite from Oracle, the only system you need to run your business. Go to netsuite.com/angel to get your free guide called Crushing the 5 Barriers to Growth.
Hey everybody, welcome to Angel, the podcast. I'm your host, Jason Calacanis. You can follow me on Twitter. I'm at Jason, or Instagram Jason. And you can follow me on Amazon. Buy the book, Angel. Go ahead and search for it. You can see it right here if you're watching the video. We do this podcast 10 times. We're in our second season. And this is a podcast for people interested in angel investing and early stage investing in startups, specifically here in the Bay Area, but also abroad. And it's not about, because a lot of confusion has come up recently with people saying, oh, angel investing, what about movies? What about pizzerias? What about dry cleaners? That's a different thing. Those are called donations. You will not get your money back if you angel invest in a movie or a book or whatever. Just consider those donations. What we're talking about here is doing this for a living and having a return. Hopefully a return that beats the stock market, right? So if you're going to take the time to invest in private companies that are illiquid, you would hope that the return would be greater than being in liquid shares in Netflix or Facebook or Google or whatever you want to invest in the stock market. There are many different ways to get into early stage investing. Sometimes people get their MBA and they go directly into banking or into venture capital because they know somebody from their fraternity or sorority who is doing it already. Other people say the best way to do it is to come out of a startup or working in operations in a big company. Our guest today comes to it both from being at a large company, Yahoo, where you manage growth, and also working at startups and being CEO of a company. So welcome to the program, Arjun Sethi.
Thanks for having me.
Great to have you here. You work at a social capital partnership now. And but before that, just to give people a general background, what did you do before you became an investor?
Post-college?
Yeah, we don't have to go through if there's a great story from high school or childhood where you
No, there's no great.
did some amazing startup business. But it's actually interesting when you're a founder, almost every founder has an adolescent entrepreneur story. Do you have one where you did something entrepreneurial in your youth?
I did.
Tell me.
I quit high school.
Quit high school?
I quit high school.
Oh, what did mom and dad say about that?
They were not very happy.
How do you have that conversation with your parents? Hey, mom and dad, I'm quitting high school. What did they do?
Yeah, well, I grew up here, so my dad was an entrepreneur as well, and so I kind of watched him build his company.
What did he build?
So he was in the networking stack, gigabit switch in the mid to late 90s.
Like the Cisco world or
Correct.
Stuff like that.
Yeah. So and also on the security side. So I watched him build his companies, very successful, and I said I could do these same things. This is before I went to college. And so what I decided to do is I was into cars and aftermarket parts. I dropped out of high school. Dropped out is probably a good way of saying it. I think I was also kicked out at the same time. So it was a good way to say no, I don't want to be there.
It didn't work out.
Yeah. And so some friends and we started building aftermarket parts. A lot of it was just manual welding and creating the parts ourselves. And then eventually over time we started manufacturing it. Wow. Not huge scale, but it was a company.
Is this for like drifting cars or some specific type of car?
Yeah, so we specifically built turbocharger applications for cars that were not naturally, that had a turbocharger inside.
This is when people change the chip to turbocharge the engine or physical hardware to do it?
A chip would be a part of it, but we used to build these kits. So it was multiplicative.
And then would it cost a couple grand to make your car go faster?
Yeah, $3,500 was kind of the sweet spot.
Nice. My first business, I think this is my first business, was Jason's Hot Tapes. My dad won a copy of The Empire Strikes Back. He was playing backgammon with the guy. The guy got into my dad for a couple of G's. The guy said, I don't even have the VIG. I can't pay you the interest, but I got something. I know your kids love the Star Wars. We recorded The Empire Strikes Back when it was in the theater up in Bensonhurst. And he gave my dad a copy of The Empire Strikes Back that they had recorded. They put 3 video cameras in the back of the room, and this is in the early 80s. My dad was like, all right, that's fine. He gave it to me. Then I figured out you could copy it. So I copied it, and then I sold copies of The Empire Strikes Back, which was not a high-quality copy, but it wasn't available for $20. I sold about 30 or 40 of them. Sorry, George Lucas, I owe you $1,000. Royalties. But it's almost, and my dad was a bartender who had a bar. Entrepreneurial dads build, and moms build entrepreneurial kids in general.
It's possible. I think although my sisters didn't go that route, they went the more traditional route. And I also decided I wanted to go the more traditional route, and I didn't like the whole startup scene, all these companies, crazy ideas. Most of them don't work. My dad was also angel investing. He had his own venture fund during that time frame. And so I just watched a ton of failure. So I went to the East Coast for school, and I decided I was never going to come back. But I came back.
It's fascinating because I always make the joke that nobody is born, or almost nobody I've met here is born into this, except for Tim Draper's kids, who are, by the way, and Ron Conway's, who they're incredible investors, hardworking, and have done really well for themselves. But you actually were born into this.
I was, yeah.
That's amazing. Yeah. Okay, so you worked at Yahoo for a while doing growth. Did you sell them a company and then you went to work for them?
Yeah, so my company MessageMe, which we started about 4.5 years ago. We sold that to Yahoo, and then we ran the growth and data science team there. So we started that team, and then continued to expand it on the marketing side. And then we also ran what we call the mobile and emerging products teams.
When you were at Yahoo, did you ever have the sense that it was possible to right the ship? In other words, when a giant company is past their paradigm, display advertising in this case,
sure,
does it feel like you're just gliding it in for a landing, but there's no way to get it back up to altitude?
Yeah. So I have a lot of thoughts on this,
Yeah.
and I've written about this a lot. I think to change the momentum of if you want to take like the analogy of a boat, right?
Right.
Like it's huge and you have to like move in different directions, especially when it has a certain type of momentum and the wind is carrying it.
Yeah.
It's just really hard to move. And in order to do it, you kind of have to just stop, figure out where you want to go, and then start. And it means you kind of have to start from scratch almost.
Right.
That means you have to cut a lot of heavyweight out. And I think Marissa and a lot of the team were just not willing to do that. And they might have done a slow bleed for some areas, which eventually was the same outcome. But the amount of time that passed was just so long that you kill morale, you kill momentum, and you kill your ability to figure out what you want to do next.
And this was apparent to everybody going in. In fact, Mark Andreessen said, whoever wants to be the next CEO of Yahoo, famously, if they just cut half the employees, it'll be a great business again and they'll be really strong footing. But Marissa couldn't do that.
Yeah, great business allows you time, builds you a certain amount of moat for the short term to figure out what decisions you want to make moving forward.
Right.
She didn't want to do that, and I think a lot of people internally didn't want to do that. And that could have been also a leftover of the media style attitude of the people that were there during that time frame.
Yeah. I also thought singular focus is so important in a business, as we all know. And I was like, if it was me, I'd focus on video because that seems to be the closest to the DNA. But could be mobile, could be social, but they have no social DNA. I guess they bought some mobile companies, so maybe they have some mobile. But it seemed to me video would have been like just go all in on video. If you were a CEO, what would you have gone all in on if you had to just pick one thing?
I don't think it's a question of one thing. I think the fallacy has always been, let's figure out what the trend is, and let's follow that and figure out if that will work or not. And I think the part of the problem there is you had 1 billion people per month coming to a suite of products that were very retentive. We're going to continue to come and we're loyal.
Right.
And what you were doing is you were kind of snapping them away from something that they've been doing for such a long time.
Right.
In some cases, 10 plus years. And saying just use this completely new paradigm and shift of products.
They don't want to.
It's very hard to do that. It's like asking someone who's older to change their habits completely, and it just gets harder and harder as you get more ingrained. So if you look at any generational products, it typically starts with an audience that's willing to take a risk or they have time to think about that new product. And I think any company that has eyeballs will always face that. Facebook, Twitter, even Google in some circumstance, where people get used to certain products. So for Yahoo, they had their web portal, they had search intent, they had Yahoo Mail, and people were coming there for that. And you can say sports, finance,
sports,
stock,
finance, some of the
but
stuff.
those are still offshoots of their core, which was news, search, and mail. I would have gone back and said, okay, how do I just continue to make these the best products?
See, that's what I mean.
Across
I
multiple
thought
platforms.
news would have been great if they just kept doing more video. Right. And if you look at how podcasting has boomed and talk has boomed,
correct,
they were so in the pole position to say on Yahoo, because they had done one early experiment that I thought was really telling. They had Henry Blodgett at Business Insider when it was nascent. I don't know if this was during your time, doing like a Yahoo news program for a couple of years and on finance. And I was like, this is like, I kind of like this as much or more as some of CNBC's offering.
Sure.
And it increased my habit of coming to finance.yahoo.com. If you typed F in my browser, you went to finance. That was my autocorrect. My most frequent visit was finance. Not, I don't go to Yahoo Finance anymore.
I mean, I think some people would castrate me for saying this, but I think you have a huge problem in the Valley after Steve Jobs and his perspective of how to build products, that everyone wanted to emulate themselves in the same aura of who Steve Jobs was and figure out, can I look the same, feel the same? Can I have this montage of how I think about my company, my products? And I think Yahoo fell into that.
Yeah, that I have to be the tastemaker.
Correct.
And I never saw Marissa as a tastemaker anyway, so that was a really weird position to put her in. And also the position of putting her in charge of all those people and not being, I mean, they just should have fired everybody. It would have been so much easier if she got to half of the people there. But there was this weird drawn out thing, like you're saying, where they were just cutting whatever number of people per month, and it just created this weird vibe in the culture. What did you learn as a CEO before we get into your investment career? When you look back on yourself as CEO, you did 2 companies, I think.
I've had like 12 companies.
Right.
There's 2 that I stayed on my LinkedIn profile.
Okay, good. Yeah. When you look back on the entrepreneurial career, what do you think you did particularly well, and what do you think your limitations were as a founder?
Yeah, what's really funny is I actually felt that I was a better CEO and leader in the earlier stages of my company's life cycle. And then in the mid-tier, I did pretty poorly, and then towards the tail end, I did great again because I just kind of learned what happened. We got lucky in our first set of companies. So Lolapps was one of the first companies we had started. Funnily enough, actually, it started a different company. Lolapps acquired me there. I became the CEO, and then the CEO became my VP of product. And we're still very close today. And what I didn't know enough about the space, right? So I think it was more about I was rapidly learning and iterating what I needed to do. And if I thought about myself as a product, what did I need to do in order to become a better leader, product lead in some cases, depending on where we were at the company stage. I think I was just always open to learning from other people's expertise. And what happened was that when you finally succeed, all of a sudden it gets to your head and you just have this massive hubris that everything you learn now is just going to continue on the same pathway. And then everything I did was like, oh, it's got to be my way because I know. And I think that was the biggest mistake, was that it's how can you be open and stubborn in some cases, but willing to change your mind when you know you're wrong.
In a way, in these early days, you know everybody on the ship. It's like a small little SWAT team. It's like a little SEAL Team 6. But then you start getting into, oh, hey, I'm commanding an entire army here. And what got you here is not going to get you there. In other words, what got you through phase 1 is not going to get you through that phase 2. And it is a really hard shift, right? Like to say, okay, now I'm going to get into radical delegation. I'm going to let people do what they do best, and they make the decision.
It's also very hard to scale once you go from 5 to 10 to 15 to 20. It's really hard to scale yourself because you've been in so much of the tactical weeds about taking yourself out of that. Because then you have this fear that a lot of people will think you're not doing any work, but you actually are spending more time strategically thinking about where the company might be moving forward, assuming you're scaling in that direction. And that's the hardest thing to do, because if you are helping, let's just say you were coding with, the rest of the engineers that were there for, over the last 5 days, you feel like you're accomplishing something, but you might have not actually compounded your knowledge and your time of what you could do moving forward to help address where the company and the strategy needs to do in order to move forward.
Yeah, it's very interesting you bring that up, because it is something I faced too as a founder, where I was like, well, I have to write everything. I have to interview everybody. I have to, be involved in the sales. And then at a certain point, you're like, well, if I'm involved in the location of the next launch festival and getting the speakers and getting the advertisers, this thing can never scale.
I think the key word you used is I. Yeah. And so you just have to get used to saying we.
Yeah.
And then when I think it's actually really great when you say we more often.
Oh, it's great.
You start thinking about, okay, well, where are the holes that I have on my team that I need to fill?
Right.
Because
Where's
I'm
the
saying we, but I actually can't fulfill the A, B, and C. So I need to get on that.
So why did you decide to become an investor? You did pretty well with MessageMe. I think that was an okay exit for you.
Actually, Lolapps was the greatest exit. MessageMe was great as well. But I think it was at a time where like Zynga was starting to plateau as people stopped caring about the industry, which was great. And then we had a nice outcome with the Japanese company.
Right.
But I actually started angel investing in 2007. And,
good timing.
And it was actually at a time frame where I used to listen to what you used to write Dave McClure at that time frame as
Right.
well. You guys just started having a lot of content out there.
Yeah.
And so for me, it was as I was thinking about, I have this new company, I don't know as much, I need to learn.
Right.
A lot of it actually started off as if I was to pay my way into understanding where I need to be better, I should just invest in other companies that are at the innovation edge, where who's pushing what, and who's better, frankly, at what.
Yeah.
You know, product management could be technology, could be leadership style management. So that was actually my way of trying to understand how I could level up myself and my team.
Right.
And so a lot of those investments in the beginning stages were about areas that I was interested in understanding that could help propel my company forward.
Yeah, something people greatly underestimate when you make an investment, even if you only put 10K or 25K in, you get this massive deluge of knowledge that could then lead you as a founder or an investor into the next huge outcome in your life.
Correct.
Because you're not investing in schmoes and dummies. You're investing in the best of the best, the brightest of the brightest here in the greatest arena for startups in the world.
And even if they were not successful, you're watching them learn and you're learning their mistakes. And
It's like a lab experiment. Yeah.
And you have context as well, right? And vice versa. Right? A lot of these people were investing in my companies at the same time. So I got like this crash course while I was building my company and scaling it from 50 to 250 people and then down to 75, firing a bunch of people, and then moving it up to 400 people and getting up to 1,000. And again, it just, you know, this contraction and expansion.
The layoffs are the worst, aren't they?
And then it is the worst. It's the first time is the worst, and
Your legs shaking under the table. Yeah. You don't sleep the night before. You go to the bathroom and puke.
My co-founder had cried. I had a tear in my eye because like he was crying, and I was just like, man, this
the
is
worst.
Hard stuff.
I had one time I was laying people off after the Google Panda update at Mahalo. It was like this. We just went from, you know, the 140th largest site in the world to Google can't find us on the internet magically. And I was like, I'm laying people off, and this one woman is crying, a young lady, and it was her first job at a school. And I said, it's going to be okay. You're like super talented. You're going to get severance, and we're going to, you know, and she's like, no, it's not that. I know I'm going to get a job. I got like 3 offers already. She's like, what's wrong? She goes, I just love it here. Yeah. And I was just like, oh.
No, it felt good.
Shot.
I remember when we did our first riff.
Yeah.
One of the employees that we let go, he said like, we're going to have an after party of everyone there. And they actually invited me. So out of the 40, 50 people that we fired,
invited you.
They invited us to come and talk. And it was a good crew of people because we had spent, it was during that time frame where actually no one could find jobs. So you had this cluster of people in the community coming together to help each other out and propel forward.
Yeah.
And so when you work together for 4 or 5 years and watching everyone go through the motions of the struggle, it kind of bands you together.
Right, it does. So let's talk about you become you do the angel investing, but then you decide to join Social Capital. What was that decision? How did you find Chamath, or Chamath find you? Was it a recruiter or something, or you sort of wanted, or you just met him? How do you wind up at Social Capital? Because this is, I think, of all the new funds, it's the most successful right now.
Yeah. So funny story. During the Lolapps stage, I had spent some time with Chamath when he was at Facebook. And the first thing he had told me was, you'll probably fail on the Facebook platform, so we will just acquire you. That really pissed me off. So I was like, fuck that. I'm gonna work as hard as possible to make it successful. We did make it successful. And then when I was transitioning out after we had sold and I'd been there for about a year and thinking about what I wanted to do next, in parallel, Chamath and his co-founders I had also met previously, and I had pitched them, and they basically came back and said, hey, we just started Social Capital about 6 months ago, got a new place, new office. We'd love to have you and your team sit there. I know you're going to do something new. Yeah. Just come as an EIR. I had just had my first kid. It was like a cool free health insurance. Yeah. Let's do it. Yeah. So I was there and I saw what they were incubating, a bunch of other companies, some of which are, there today and scaling really well. Again, it was just like a band of a lot of smart people around the table. And as well as my team, and I started my company, went off, got funded, did the whole servitude to Yahoo for a while, the tour of duty, and in parallel, I had started angel investing at a higher and faster clip. Then I had my own angel/seed fund, and I had a bunch of some LPs, and and I think when I was thinking about moving forward, they just came back and said, hey, can you replicate in some ways some of the success you've had with the community of companies you've built out, the success of some of the companies you've been in really early, and just writing larger checks. Would you want to do that at social capital? And I had already had thought that I would go into venture eventually, just probably not that soon. And then I think the conversations just progressed, and it was exciting because the way in which we approach venture investing today at the earliest stages to the other life cycle was very similar to my thesis of what I wanted to build, but they were already in that direction. So I thought, okay, if I like the people, I like the mission, I like the way in which we're going to make investments, might as well just
What
join
is your
the team.
thesis around angel investing? What did you have a core thesis on what increases the chances of a great outcome as an investment? Or do you have a way, do you pick founders, do you pick markets, do you pick products? What do you look for?
Yeah, so if you, I go back and forth on this year to year because it changes. But I think at the earliest stages when people are coming together to build an idea or a product, I think all you're assessing is the team's ability to execute, rapidly learn, and become better and better. I mean, can they compound and become better and better? And depending on what they build, it doesn't matter what they shift into. Do they have the resiliency to figure that out? And so product and market mean a little bit less because the team might change their product, might change the market they're going after. So I think the team matters. But then that's why your check sizes are much smaller at that stage than a larger check size. And then I think as time progresses, then product and market become more and more important around what they're focused on, because you can have a really good profitable business, but might not be a venture scale return. And so then I think that's where market makes a big difference as well, where you're spending your time, because again, good product, bad market, really good market, mediocre team, mediocre product could also still work.
Yeah, you have seen that a huge market can lift a really average team and propel them to great success.
Correct.
And you're like, wow, these people, I didn't think these people could do it. But the market was behind them. The wind was at their sails. And
the other part is,
take off.
Could it be a mediocre team that becomes better over time, and you need to assess that ability? And so I would say probably 50% of my angel investments and even early seed bets have been more around, do I like their product? Do I like the market they're focused on? And do I think the team just has the capability? It might not be the greatest team, but do I think they have the capability to become great over time?
How do you source your deals now that you're in this sort of, I know social capital probably has inbound. People know about them. They see Chamath on CNBC. They see you out there in the field. And they say, maybe I'll just send a business plan or whatever. But I'm assuming the cold over the transom, decks are not as good as the ones that come from people you know. So how do you source deals? Yeah,
I have a pretty wide lens and aperture towards what I'm looking for, what I might be interested in. So I'm actually more outbound and cold email kind of person, which is like, hey, I've been spending time in X industry and like this approach. Do you just have time to have a chat or a coffee, whatever it may be?
So then the founder,
and in some cases even a phone call.
Wow.
So actually a lot of my angel investments, some are obviously inbound as you have progression, and a lot of those founders introduce you to other founders. But a lot of it was more like, hey, I heard about your company and saw what you did. I saw a talk, maybe a blog post, just some understanding. I started building my own sort of query search engines when I was doing seed. So if I saw something that was interesting or would tick up, I would just reach out.
So you made queries on AngelList or Crunchbase?
Crunchbase in the beginning, AngelList at some point.
A
lot of app store sort of denominations of what was happening in different industries. That's how I found a company called Truecaller in Sweden.
Truecaller right now in Sweden, sure, of course.
So seed stage, I reached out to them cold.
Wow. And you made that investment?
I made that investment.
When you were at Social? When you were?
When I was at MessageMe, actually.
Wow. So you just knew Truecaller, which obviously, for people who don't know, will tell you who's calling you, and if you mark something as spam, everybody else gets to mark it as spam, and they build like sort of a central database of numbers.
It's much more region-based, but I would say in some cases it's white pages to the max, and white pages does exist here in the United States. So I would say it's not as core and central here. But if you are in Europe, Africa, India, Asia in general, it's a huge problem because they never had that infrastructure. Then they never had caller ID, and so it's a new concept. And so in the same way, I would say you had like WhatsApp kind of, everyone 2020 hindsight, they said, we should have paid attention to it. But in 2008, 2009, 2010, they were growing, but no one was paying attention to them.
Right.
But it was
by
all
watching the App Store, which is interesting. Okay. So when we get back from this quick break, I want to talk to you a little bit about, wow, Truecaller is now a unicorn. And you invested in the seed stage, probably worth $5-10 million.
Yeah, I don't really count or think about it, but in the early stages.
Yeah, if it was 10 million, you're 100x now.
There's a lot of companies like that
that you've invested in.
I hope so in the future. Yeah.
All right, when we get back, we're going to go through some of your investments in our portfolio review on Angel, the podcast. Hey, everybody. Let me take a moment to thank NetSuite from Oracle. Yes, the results are in. If you look at Survey Inc.'s 5,000 companies, the top 5,000 companies, the top 5 barriers to growth for those companies were: 1, it takes finance way too long to close the books. I experience this all the time. 2, our company is too slow to launch new products. We got a bottleneck. Number 3, hiring and keeping good people. This is critical for all companies. You know that. 4, managing your cash. You need to have cash in the bank, right? You don't want to run out. And 5, too many disconnected systems, making it hard for you to get a full picture of your business. Now, it sounds like these businesses have outgrown their business and financial management systems. You know that you use spreadsheets and QuickBooks and all these other systems, and they're fine at the start. I get it. You're saving money and you don't really know what you're doing. Well, it takes twice as long to get simple things done, sometimes 10 times as long, and it's not going to be accurate. And you need those accurate answers to make decisions for your business, and that's where NetSuite comes in. They are the #1 system for growing your company. It's the one system that tracks and manages revenue, cash flow, HR, inventory, projects, and even e-commerce, and for every single industry. It doesn't matter if you're in software, hardware, a marketplace, B2B, B2C, B2B2C, does not matter. NetSuite's going to work great for you, and you can run your entire business from your dashboard on your desktop or even on your mobile phone. And that's why thousands of companies use NetSuite. It's the only system that you need to run your business. So here's your call to action, everybody. Go to netsuite.com/angel. Please go to netsuite.com/angel and get your free guide, Crushing the 5 Barriers to Growth. That's right. We talked about those 5 barriers earlier, and you're going to be able to crush those 5 barriers. Doing the books, HR, launching new products, managing cash, and all the disparate systems you use to try to figure out what's going on. You're going to go crush those 5 barriers to growth at netsuite.com/angel. Please go there, netsuite.com/angel, and get that free guide. It's the only system you're going to need to run your business. Let's all say thank you to NetSuite from Oracle for supporting independent media like Angel and for supporting season 2 of this amazing podcast. We've had so many great guests on, and it's all because we have NetSuite support. So just from me to you, NetSuite team, thank you. And on behalf of the audience, thank you. Okay, let's get back to this amazing conversation. Hey, everybody, welcome back to Angel, the podcast. You can visit us, angelpodcast.com. We're also on the Spotify now. Thank you to our friends at Spotify for including us in their awesome new podcasting app. And if you love the show, go ahead and write a review on iTunes and rate it. That's super helpful, helps other people find it. My guest today is Arjun Sethi. Sethi. I got it.
Whatever works for you.
No, I got to get it right. Sethi, right? Sethi.
Go by Sethi, and then I go by Sethi, depending on who I'm talking to.
Some people say Sethi. It's pronounced Sati.
Sethi.
Yeah. And he is a partner at Social Capital. I don't know your title.
I'm a partner.
Yeah. And you focus on the early stage at Social Capital. You lead that group, or
I lead the venture group.
You lead the venture group, and that's early stage to Series A, seed to Series A.
It's actually seed to Series B and C in some cases.
Wow. Yeah. What is the seed strategy over there at Social Capital today? Because we know the firm has gotten much bigger and has much bigger aspirations to play, not just in the venture space, but all the way up until hedge funds and cryptocurrencies, and then all the way back down to seed. So where does seed fit into all of this? Because I hear Chamath say all the time on different podcasts and when he's speaking that he is stage agnostic.
Yeah, so part of the strategy at Social Capital has been we don't want to miss at any stage of a company's life cycle, and we also want to learn and continue to figure out what are the best ways in which to invest, right? So some of it's data-driven, and what parts are qualitative. So we have this shared platform and learning. So for seed, it's more about, as I mentioned, what are the particular verticals that we want to understand about a company, and then what check size do we want to participate in? Do we want to take a community-based approach of we like this ecosystem, so let's invest in a bunch of companies in the ecosystem, or do we like one company in this category? I think for us, what we drew back from, and this comes back from my seed fund days, was that you had a lot of party rounds. You had a lot of people saying, We want a certain allocation or percentage of the company. And that's really hard at the seed stage. And a lot of these funds, I would say, including us in some capacity, wouldn't be there to help because their check size might be too small or the ownership might be too small. So we separated, at least at the earliest stage, what do we want to do with incubations? What do we want to do with seed? And how do we want to think about early stage venture where we take a board seed? So we started debating this, and then in some ways you start experimenting what's working, what's not.
Yeah.
What's worked really well till date, and this is, again, an artifact of what worked at my seed fund, is you deploy small amounts of capital in areas that you think are interesting and people that you believe are interesting, in ecosystems that you believe are interesting, and then you start deploying more and more capital as you start seeing progression. That means you're paying attention. It means you have a system and tools in place, even community in some cases, to help propel these people, these companies together.
What's an example of this?
So space and satellite communications, I would say, is one where we focused on social capital, where we made a bunch of bets across the board. We learned more and more about what was happening in that industry. We chose 2 companies where we deployed more capital, one at the seed stage, one in the Series A. And it
What
just
are those companies? Are they public that you invested in?
one of them we don't talk about,
Okay.
Stealth, but another one was called Relativity Space. They're the 3D printing company where they're actually building the full space rocket, start from the hull to the engine itself. And the whole goal was, how do we reduce thousands of parts into single digits?
I saw Chamath tweeted them firing their engines for the first time, and they were able to fire an engine with 3 pieces in it, or something like that.
Correct.
Is that right? 3 pieces?
Yeah, it's 3 pieces.
So this is going to compete against SpaceX, I guess.
Correct. It's it's a dual prong approach. One is they're 3D printing the engines. So the miracle is that we have to create the engines, and we have to create the space rocket that works, and they have to create the printer that can allow them to print those pieces.
Wow.
So it's 2 different pieces in parallel that they have to build. They were able to do both. But what's great is, in order for us to understand this industry, where in the stack we wanted to invest, we started investing small amounts of capital in the ecosystem to figure out where we want to spend our time.
What's a typical check size when you do a seed stage investment, and what type of valuations are in that range? Yeah.
I would say, we invest 25 to 250K on average, and I know that delta is pretty large, but those are the numbers that we invest in. And then we'll start investing more and more capital as time goes on. The valuations we'll see between 5 or 10 million cap, sometimes 4, depending on regions.
Yeah.
And we will do caps that are a little bit larger if we believe more in that space or that ecosystem.
How do you communicate to the founder what the goalposts will be to get continued funding? Because this has been called the signaling risk in Silicon Valley. A VC firm puts, a Sequoia scout like I was, puts money into an investment, but Sequoia doesn't do the Series A. Does that mean they don't love Thumbtack? Well, they did the Series B.
Sure.
Is this an issue anymore, signaling? It seemed like it was an issue 10 years ago, or it was a concern, maybe not an issue, a concern. Is it a concern now? It doesn't feel like it to me. I
think it was a concern in the past because you just had so many different companies get funded. And I think the main problem is you have a large fund coming in and saying, hey, we want some amount of ownership. Who knows what that might be. And they say, we also need to deploy at least $400,000, $500,000. The problem with that is if the company, now you see more and more companies raise up to like $3-4 million in their seed round. And so if you had one of these major institutions just give you the first 400K and then never pile on later on.
Yeah.
I think it's a pretty bad signal. Not to say it's a good or bad thing for the company, but it could be a bad signal, especially if you raise your first $1.5 million and you need subsequent rounds of funding to help propel you forward.
Yeah.
So again, our mechanism is we might give you the first 25K check, we might give you this 50K check, we might even give you another 75K check after that. But that means we will participate in subsequent rounds of funding.
Right.
So we take a different approach.
Yeah.
And I think, it probably would not be a great signal if we don't participate moving forward in your subsequent seed rounds. But we always never participate in the Series A. But our goal is to help the companies get to the Series A. So out of the, 100 companies we've done in the last year and a half, about 20% of them have raised subsequent rounds where we may or may not have participated. I don't know the number off the top of my head. But out of that, I would say 10% have raised Series A, and only 2 of them have been from us.
Amazing. Yeah, and see, I think this is where the statistics lead me to believe it's becoming less of an issue in the Valley, where it feels like it could be a negative signal, but I think people are so busy and there's so many investments that we all look at and say, we're all drowning here in deal flow. There's too many deals. There's too many good companies. There's too much traction amongst too many companies to even make a decision. How is that what you're going through at Social Capital when you have a popular firm that's invested in things like Slack and have breakout success? Is there just too much incoming for you guys to sort through over there?
I would say yes and no. I mean, there are areas and sectors we know we're not going to invest in. So those are easy to filter out. And we let the entrepreneurs know that ahead of time. But we're also continually learning areas of interest for us, right? Like Frontier was not that large of an investment category for us at least 3 to 4 years ago. Now it's a pretty large part of our portfolio. And
what does it mean, Frontier?
So funnily enough, I would say all hard tech, right? So things that were semiconductor chips, AI, ML, which probably shouldn't be called Frontier, but we call them Frontier. And space, satellite communications, part of Frontier, food, agricultural tech, areas where they just haven't been considered traditionally consumer metrics or enterprise metrics, at least over the last 20 years. You could say maybe traditional venture investing over 30 years ago coming back, we're calling that Frontier today.
Yeah. Well, and you guys are doing the TensorFlow team is building a chip over there. That's public now. That's an example of something that's super frontier tech. Yeah.
Amazing team, amazing tech. I would say it's a very traditional venture deal in the frontier tech space.
What are they doing over there? What's the name of that? Is there a name for that company?
Yeah, the name of the company is Grok.
Grok?
Grok.
Kruk.
Yeah, GROQ.
Grok. Like as in grok, as I understand. GROQ. When does their product come out? These are a bunch of Google folks, I guess, and they were working on machine learning AI, and now they're making a chip. And this is something you guys source them over at Social Capital and back them. You're the first and only backers of them, from what I understand. I don't know if that's true.
We are currently the first and only backers.
Yeah. So this is like a big, crazy bet, right? To do something like that?
I don't think it's that crazy. I mean, we spent so much time, again, learning by making seed investments, learning about the ecosystem. We had an understanding of where we wanted to deploy more capital, and they were one of the bets that we took.
Got it. So you do these seed. You're placing a bunch of little bets. You find the TensorFlow team or this team that's doing Grok eventually, and you're like, this is the one to go all in on.
Yeah, I think the best way to think about it is, and you've done this in your past life, is you're making investments in a category, in an ecosystem, because you like what's happening. There's a flavor or a certain amount of herd mentality, but do you really want to participate in some things that may be overblown? And maybe you don't want to be a part of the herd mentality. Maybe you don't want to invest in that ecosystem, but you don't know yet. So part of it is learning in the early stages, and do you want to deploy more capital? You might deploy more capital to those companies as you're learning. You're also helping them propel. Or you decide, I actually want to invest in a company that I heard about that all of these companies are using. Maybe it's on the B2B enterprise side. Don't know. And I think part of it is a lot of people opine and say, we know, we love this, we saw the founders' eyes, we believe in it. But if you actually go back in history, they didn't. And it might have been the only company in the ecosystem. Or there might have only been 3 companies in the ecosystem, so they chose one of 3. Today, you're choosing one out of N number of companies. It could be in the thousands in some cases.
Is there a type of founder or founder traits across the Social Capital portfolio when you look at it and you say, yeah, our founders have this in common, that you can think of that just comes to mind off the top of your head?
No, you know what's interesting is every company is unique. Every founder is unique in their own way. They operate their companies in some cases so much different. And it's really interesting to watch them execute. You'll have 2 great companies execute completely different, but there would be no way to bring one culture into the other, because it would just fail. The whole thing would fall apart.
Right. So there's no one way to succeed, just your way and your ability to execute on your strategy.
We tell a lot of our founders, and I say this, just, there was something special about what you built and helped you propel from stage to stage. Just continue to do that better. And here are like the basic accounting principles of growth or retention, revenue, unit economics that you want to use, and then plug that into the way and what you do really well.
Tell us about this capital as a service idea. I think it's called capital as a service.
Correct. CAS.
CAS. I heard this and I was like, that's the opposite of what I do. I'm trying to actually, and I think Chamath and I have a core difference here. I'm trying to pick people. I think I'm good at reading people. And there's very few metrics there. And you said earlier in the seed stage. So is CAS something that works later stage when you have a lot of traction, or does this CAS algorithm and this process you're doing work for when there's not a lot of data? Yeah. How do you look at that versus what we seed stage people typically do, which is we pick teams. We look for people who have purpose and mission and skills, right?
Yeah. So where I'd agree with you is at the earliest stage, you don't have a lot of data, so it's harder to make those types of bets. So you're making team bets rather than product and market bets.
Right.
CAS comes in right in between, I want to say, what we call seed plus now, and the earliest stages of seed. Kind of right in the middle where there's some amount of momentum, certain amount of traffic, certain amount of revenue, certain amount of data and metrics, where you're starting to able to see what a company is doing without the bias of all the other parts. And I think that's our beginning stages of learning and understanding what's happening, in my opinion, just all across the world. Because companies are not just being built here, they're being built all over the place, and there's ecosystems just like burgeoning in different areas. That's really interesting. And then what we're able to do is allow them to propel forward as well by saying, here's a benchmark of other companies at your stage, here's where they're at, here's how you need to think. And I think if we can do a really good job there, then we can help propel these companies and communities where we're investing.
Yeah, it was very interesting. I had sent a enterprise company, and it was maybe 2 years ago that was doing their Series B. They got the Series B done. Social Capital didn't do it, but they gave the founder a report on here's where you stand versus Slack and companies we haven't invested in like Yammer in terms of enterprise growth. And just here's the fastest growing enterprise companies, and here's you. And there's a problem with churn, and there's a problem with retention here, and here's where we would like to see you in order. And the founder was just like, wow, this is like why didn't they invest? They put all this work into it. It was confounding to them, that the firm that did the most work didn't invest, and the firms that didn't do as much work did invest.
Yeah. We have a philosophy where we want to be as transparent as possible with the founders when we meet them. And again, it was very in line with the way in which I had done my seed strategy, which is like, here are the parts where I feel you might have holes, and here's where I'd like to help, and here's how why you should take my capital, and why I want to be on this journey with you. And for us is, I think, as a founder, what was really frustrating was you'd go and pitch, you do all this work. You'd work with one of these partners for a long time, in some cases maybe an associate or principal underneath. You spend a lot of time building a relationship. You go back and forth. You go do this partner meeting, and you never hear back from them, or they never properly tell you what were the real reasons why they passed. And so what we wanted to do is say, hey, we do a lot of work across ecosystems, across companies, and we have a thesis around why we may or may not invest. It doesn't mean we're right or wrong. It just means here's our process, and here's how we did the work. And so we want to share that with you.
Yeah.
And if it helps you be a better company, then you'll come back to us at some point and prove us wrong, which is great, and we want to continue to support that. Or you're a great company. We have full alignment with you, and let's figure out a way to partner. And so we share our memos. We share like all the work we do. In some cases, our official reference calls. We'll share all that back with the founder.
Wow. Yeah. So it takes a lot of time. For every hour you meet with the founder, how much more work goes into the process, would you say, on the seed stage, early,
I don't think it actually takes that much time, because you were already doing that work. You just didn't share it before.
Right. But I'm saying, if you were to look at let's say you have a 1 hour meeting with a company, how much more work do you do on average before and after that meeting relating to that company, do you think? In other words, what's underneath the iceberg?
I think it depends on if you are doing more work to understand this ecosystem, this company, and do you feel like it is a company that may warrant, more like capital from you? And do you want to take that time to understand it? So yeah, in some cases you take a look at a company and say, hey, we already have 10 benchmarks in the space. We don't like this ecosystem. And we just tell the founder that and say, here's the work we've already done for the last 2 years. And so this is why we don't want to make these investments. But for new areas, you're taking a lot of time.
Yeah.
I mean, in some cases, there's this one company I've been working on probably for 10 months, just trying to understand the space and see if I want to take the bet.
Wow.
And so some people will say that's crazy. But for me, I'm just continuing to learn, see how they're executing. They're okay with it. I'm helping in some ways. And, and if I'm ready to pull the trigger, I'm ready to pull the trigger. If not, then I'm going to help them make sure that they can find the capital they need. I still could be wrong, but, you spend your time where you think there's going to be, large returns.
It's interesting. If you think about like when you get a no from an investor, it's never a no. It's a not yet. It's like, if you were to prove them wrong, in all likelihood, you're going to raise 4 or 5 more rounds of capital before an exit. In which case, why wouldn't you take their capital in the next 5 rounds if they invest in those stages? And you said social capital invest the entire stage. So the more goodwill you build, the more candidness you give, the better off they are. Founders have to play the long game. And investors have been playing the long game for a long time.
And so do we.
Yeah.
We have to play the long game as well. And it's not a game. We have to build the relationships in order to show that we can be helpful.
Yeah. I mean, you are going to make mistakes. So then the frustrating part is when people will tell you, oh my God, I love it. This is amazing. You are tremendous. I got this once with an LP. You're amazing. And this is exactly what we're looking for. And you're going to be so successful. I was like, great. And they're like, but it's not a fit for us. And I was like, but you just said you're looking for it. I'm great. And my track record is indisputable. And they're like, yeah, so what we were thinking is we meet twice in the next year and then maybe in your next fund. And I'm like, wow, you have no credibility now. You basically just lied to me and snowed me. Like, just tell me you don't like me or you don't like my approach or you don't like this aspect. I would much rather get that candid feedback.
Just think of it this way. And this is probably why you like being an angel. Yeah. You're able to have very candid conversations with your companies. Yeah. So, in the interest of transparency and helping the companies move forward, that's where we want to get to. We want to make sure that we're partners with all of these companies, even if we don't invest. Right. And so as time moves on, we want them to be calling us regardless.
At its core, what is a startup in your mind? When you think about what we do here in Silicon Valley, what do you think is a startup? What is it, the essential nature of one?
Yeah, that's a great question. I think one of these startup events, I don't know if you were there or not, is possible. Steve Blank was, up on stage, and like that quote never goes away for me is, entrepreneurs, the reason why he believes they're successful is that they have an irrational passion towards solving something, and that they have this religious fanaticism. And I think that word it's hard to use today with what's happening in the world. Sure. But I truly believe in is that they have this religious fanaticism around solving that problem or figuring out what's next within that space.
It's an unnatural, unhealthy obsession.
Correct. And so if you're a startup, what you're really doing is we use the word culture, but you're creating a sense of fanaticism.
You're creating a cult. I mean, it is true. And, obviously there's triggers and some baggage about using fanaticism. We're not talking about terrorism here, but we're talking about a belief in yourself and the problem and the team that will never go away. That's so in your soul that you believe it to be true, even in the face of failure. I mean, the great entrepreneurs hit these horrible failure moments and it inspires the team more, right? You just think about what happened with Elon blowing up the 3rd rocket and he's like, well, now we got to get back to work.
Just keep going.
Keep going. Resiliency is everything. If you're not resilient, you're going to, and if you're not passionate fanatically about the product you're building, you're going to wake up the next day and, let's face it, it's so hard to be a founder. It's a very reasonable decision to quit.
That's the word. And as a founder, sometimes you can't quit because you also can't get another job. So you just have to keep going.
Being unhireable is a super benefit to a great founder. If you think about some of the best founders we ever had.
It's a superpower.
Their superpower is being unmanageable and unable to function with anybody else being in charge. Like literally just go down the line. Who would ever be Elon Musk's boss or Travis's boss or, Zuckerberg's boss? Like these are people, or Bezos, like you can't possibly be their boss.
Yeah. At some point they did have bosses at some point in their life.
Yeah, for like 3 months.
Yeah, so it'd be really interesting to hear what those people thought.
Yeah, I think what they thought was like, this person is unmanageable. I need to get them out of this organization because I can't deal with them. Yeah. They're just... like literally every job. I had 2 or 3 jobs in my life where I worked for other people, and almost universally, I was working longer hours than the person I was reporting into, and it made me furious. It set in me an anger that my boss was leaving at 6:00, and that I was more passionate about what we were doing and the customers we had than they were. It's just infuriating. Like if your boss can't keep up with you, and
I think the key is that they can't keep up with you. I'm not sure time is specific to that. The amount of time they spend.
Yeah, but it is an indication when people leave at 5:59 that. I guess we have kids now. We can give a. Has it changed you much since you have the kids? Your outlook on the world?
No, actually, ever since I had my kids, I started working harder, actually.
Explain.
I think
What's your theory?
I think it's just a sense of now I kind of know what's more at stake than what was ever before, and I want to make sure I can help sort of think through problems. And I think maybe I've just become a lot more risk on, but in a more methodical way than I was before. It's probably a better way to put it.
Interesting. You want to take risk.
I do want to take more risks.
Yeah. It is against human nature to take risk. How do you reprogram yourself to be okay with risk?
I think, again, it becomes that irrationality. So I kind of just delete what I think. Whenever someone says, here's what could go wrong, I just try to pretend like that could not happen.
Yeah. I had a habit very similar to that one where I'd write down, I was writing in my book when I was early days of angel investing, what I thought was going to stop this company.
Mm-hmm.
And then at a certain point I would write it because your mind wants to get that out.
Mm-hmm.
These are the things I hate. These are the things that are just going to crush this company. Mm-hmm. Google's going to create a competitive product, regulation.
I think that's where bias comes in.
Yeah.
And so there's two ways of approaching it. One, you can say, what could go wrong with this company?
Yeah.
Or you can say, what outcomes does this company need to prove in order to hit an outsized return or an outsized outcome? And then it gives you a different perspective of the type of data that you want to go collect in order to understand if you want to actually make this bet. Yeah.
Then I would cross out that list and I'd write down like the one or two things that could go right.
Yeah.
Like here's a couple of things that could go right. You know what? Maybe Uber, maybe they'll come up with a product that's so cheap that they'll triple the size of the market.
Mm-hmm.
You know, that was my thinking was I take carry car service and it cost me $120 to come from the airport. What if that cost half? I would have started using carry car service earlier in my life when I had less money. Because before that, I used to try to find a friend to drop me off at the airport, or I would take the subway.
You've probably seen many companies, so I'll give you this similar anecdote. My dad saw Google. He passed on it because he'd invested in 5 of their search companies. I passed on Instagram, even though I was sitting on Dogpatch Labs.
That would, by the way, Dogpatch Labs, when he was working on bourbon over there.
Correct. Yeah, and
that's where we held the Open Angel Forum. That was in that Dogpatch Lab pier that got shut down, where Uber presented and Cyan, myself, and First Round invested.
Yeah, and then
you worked out of that, the Dogpatch Labs.
I was there for a little bit. Yeah.
Who did that? It was a venture firm who had done Dogpatch Labs.
Polaris Venture Partners.
Polaris.
They were my investors in Lolapps.
What an innovative idea they had. They created WeWork in essentially like a co-working space.
What's great is you had this is where I think people miss on the transactional side is you had a community of people that were all working together. And in some cases, this is probably the early days of YC, or even what you see now at launch, you have a community of people working together. And it's possible someday in their lives in the future, if their first companies don't work out, maybe even their second ones, they come together and they build the next one and they succeed. And I think you saw a lot of that at the early stages of 2007, 2008, et cetera.
For sure. All right, listen. Oh, you know what? You were talking about what metrics to look for the outsized return. Did you figure out what those metrics are? Because I've been wondering.
I'm still trying to figure that out.
The metrics that would be outsized returns. Yeah, it's fascinating.
I mean, that's probably a little bit of a lie. I think everything comes down to product, team, and market. And market, you just have to do the math to say, in success, if these people are successful with the product they're approaching, what would that math look like? And I think Bill Gurley did a great job with Uber, which is to say, what would the disruption market look like if they were to take over cabs, right? Like, this is the market size. It's like you kind of have to be able to paint a picture of where you think it could go. You could be wrong, but it's directionally focused on how a company could look like with gross demand.
It's really interesting because we live in a time where people stick their neck out and have a crazy idea. Maybe it's just social media. Everybody attacks them. We always attack the new idea, the new person, so brutally. And I was asking people to give me their ideas and I would grade them, which is kind of paradoxical. Like, I'm going to grade it. Like, it was kind of my joke.
That's why I don't grade your companies when they come in.
I know. It makes me... Well, I asked you to pick your favorites, the top 3, but it's fine.
That's a form of grading.
It is. But in the incubator, the reason I do that is because it lets people It's twofold. One, it creates a buy-in from the investors if they say it's their number one, that means they're going to take a meeting with them, because you can't possibly pick your number one and then not take a meeting. So that's just my little Jedi mind trick.
Here's historically what I've seen in my own personal mistakes. A lot of the greatest investments that I lost because I was too reactionary, and I didn't take the time to synthesize and think. And so, I'm privileged that I was able to invest in Open Door, Rubrik, Clutter, Gusto. But if I think about just
Gusto's great too.
If I just think about those names as being like some of the first early checks, when I first heard a lot of these pitches, and a lot of these guys are my friends, I said no in my mind. But I said, like, let me just take a day or two to think about it.
Right.
Let me try to understand the market a little bit more. And in success, what could these companies look like?
Right.
I'm not saying that I predicted these outcomes in any way, shape, or form, because actually they're a lot bigger than I thought from a success standpoint.
Yeah.
But like, I could have said no.
That's the thing is, taking your time and freeing yourself from having to be the decider of if this is going to work or not. You don't need to decide if it's going to work or not. You need to decide if these founders are passionate, skillful, and they've got some early customers and some early traction. These are things you can actually decide on. But ultimately, the thing none of us anticipated, even Bill, as smart as he is, and he's an incredible strategist, I don't think any of us we thought car replacement. Like, people would get rid of their cars and go full Uber. But I was recently, we had a founder university, and I asked people how many people, I was speaking at a book signing, and I said, how many people have given up their car completely? They were from Brazil. And I said, how many of you don't own cars because of Uber, or Lyft or whatever ride sharing service you're using? And out of the 100 people in the room, like 6 or 7 raised their hands. And I was like, that's the market that nobody, not even the founders, could have predicted, that somebody would go full Uber or full Lyft or full ride sharing, that they just would get rid of their car.
I completely agree. And what's funny is, I remember when like Naval, maybe even you, had sent out Uber.
Yeah.
I thought it was the dumbest idea possible, like a 1% problem. So I'll admit that.
Yeah.
And then over time, I have gotten rid of my car. I have no car. I use either Uber or Lyft, like, exclusively.
Right.
And it's just much more freeing.
And the other thing people didn't realize when they were making that calculation, everybody made the calculation based on, my car costs $500 a month, my parking space is $200, my insurance is $200, that's $900, my Uber bill will be $1,400. What they never took into account was,
and your car is a depreciating asset at the same time.
Right.
Yeah.
But they never took into account that even if Uber's a little bit more, they would recapture an hour a day. And if you recapture an hour a day, maybe that's worth more. That ability to sleep, read, do a phone call, work, and that you could recapture an hour. If you're a white collar worker, that 1 hour could be worth $1,000 or $500 or $250. I mean, if you're billing it out and you're a lawyer and you're on the phone, you're getting $800 or $400. So it's real money to save that hour.
Correct.
I wonder which ones. I mean, you have to bring this with you every time you come to a new pitch, which is to really come at it with a humility of nobody knows.
Nobody knows, but I think one thing that a lot of people miss is, what are your frameworks that you use in terms of how you view the world?
Yeah.
And so I actually think about units of time. I actually just wrote a piece about this. It's because it's a big thing for me, which is, everyone has units of time. If you think about people, and like, that's their currency, they're either giving it or they're paying with it or they're using it in some capacity. And if you really boil down parts of it, I'm not saying every company gets into this, but you can boil down that framework into the way in which companies sell B2B.
Yep.
Someone's going from point A to point B. Are you reducing friction? Are you increasing frequency in some capacity? Are you entertaining people? Are you taking away time or giving away time, or are you entertaining their time? There's just so many different parts of the stack.
They always say any business that makes people money or saves them time has a really good shot. So eBay, it makes you money if you're selling.
And also saves you time from what it was.
If you're looking for the specific Pez dispenser of Darth Vader from 1978, it's going to save you a hell of a lot of time than going to a couple of flea markets looking for it.
Absolutely.
Like, you're going to find it immediately. And the buy it now button, talking about your point about friction, that saves even more time. I don't want to go through the auction process. Just give it to me now. Time. That's a good one. I got to get that blog post from you and retweet it. All right, listen, we could talk for hours, and in fact, we have. I know you don't do a lot of this, so I just wanted to personally thank you for doing it, number one. And then I also had a sincere personal thank you, which is, I always bring my companies to see you down at the Social Capital Partnership when they graduate. And not only do you take a lot of time in the meeting, which I know is valuable, speaking of time, but I found out afterwards that you met with 6 of the 7 companies, and the one you didn't meet with was because they didn't want to meet. They were raising money or something.
I think they'd already finished raising, and then I think one of them was alcohol related.
Oh, no, cannabis.
Cannabis, correct.
Cannabis. Yeah, we're not investing in any spirits, but we did invest in Kush. It was interesting, and I just thought to myself, I need to go talk to this one company that didn't take the meeting. Newsflash to any founder: if a great firm wants to meet with you, build a relationship.
Sure.
How much of what we do is about relationships?
I agree.
A significant portion of it is relationships.
But then I would have to say, maybe then I should have spent more time trying to meet with that company as well.
I know. We'll talk about it afterwards. All right, listen, this has been a great episode. Thank you so much to Arjun. You can follow him. He's Arjun, S-T-H-I. I should just spell the whole thing. A-R-J-U-N. A-R-J-U-N. That's how you do Arjun. And Sethi, Sethi is how it would phonetically be pronounced, but it's S-E-T-H-I. A-R-J-U-N, S-E-T-H-I. You're pretty active on the Twitter.
Active enough.
Active enough. When you have a blog post, you put it there.
Once in a while.
And then you have blog.socialcapital.com or something? Where do you put your blogs? Medium?
It's on Medium.
On Medium. So you can look them up on Medium. And thank you so much to NetSuite from Oracle for bringing season 2 of Angel to so many founders out there and other investors who are looking to solve the world's biggest problems through entrepreneurship. And a key piece of that is giving them the fuel. So early stage investing is critically important to saving the planet. It literally is when you think about it. I mean, so sometimes you like think about the gravity of what we do. Like we sign the checks to the people who are going to change the world. It seems inconsequential sometimes, like, oh, you're just investing money, but it's like, no, you're not just investing money in like futures of wheat or something.
And you're investing your money and your time behind those people.
Yeah.
And you have to think about it in a 30-year horizon. I
just had this finless fish on the show on This Week in Startups, and I'm sitting there going, how do I not invest in this company? The ocean, and you know this company, they're doing like the mock
I've
fish.
heard of them, yeah.
And I had them on the program, and I got a Emmy Award-winning producer, Jackie, can you make sure that we have a follow-up meeting with them? Because I need to invest in this company. Arjun's like, do you just announce that? Yeah, I do. I kind of do. I literally have a video of me asking Alex from Calm.com when he was on the podcast if I could invest and have advisor shares in the company. And in
the negotiation, did it work out? And
I did the negotiation on air with him, and it worked out, yes. And we did a syndicate. That's public knowledge. And that company is one of our great successes that nobody would ever be. Everybody made fun of me. Like literally somebody posted on Quora, is Jason going to lose $400,000 investing in a meditation app?
Well, how many companies do you know people made fun of for investing, but it ended up being awesome?
Almost all. I mean, Slack was a goof. People are like, oh, a chat room like IRC
was worse. Game company first.
Yeah.
Moved over into an IRC chat group.
That's Stuart's like classic move. He's like, I'm going to do this incredible virtual game world. It didn't work. What can we do with the last 3 weeks of runway?
Yeah.
Flickr.
Yeah.
He's the master of the save.
Yeah.
The next time he does a company, here's what we should do. We should give him $10 million. We should light 9 million of it on fire.
Yeah.
And then say, here's $1 million left. Go.
I think it's more like you give him $1 million or less, wait 2 years, and then just without him even saying it, just give him a note and have it convert over at whatever price.
Exactly.
Probably better strategy.
Just give him the $1 million, give him the open-ended note, and then just say like, just paint or go on vacation, come back. You'll find some inspiration. It really does prove the point. Like it really is about the founder. I mean, he's now done it twice, where he pivoted into something extraordinary. It takes a lot of guts to pivot, doesn't it? What's your advice when people say they're pivoting? Do you have like some standard advice or sage advice to? And in his case, that's what we call a hard pivot, going from completely different direction.
Yeah. I typically tell people, hey, if you really believe that you can do something here and the market is there, just keep going.
Keep going.
And the pivot might end up being just a small little delineation of what you were originally assuming you wanted to do.
Yeah.
Because that's typically what most products, they evolve anyways, until you feel like you need to give up. And you never really know. I've also seen people just prematurely stop development, and then someone else picks it up and makes it 100 times better. So it's hard advice to give.
In that case, there was, I remember Twitter had come out, and then Pounce was
I remember that.
You remember Pounce by Leah? I forgot her last name. And then she went to Y Combinator and did IRC in a box Slack before Slack.
Yeah.
And Leah Culver was her name.
I'll give you my own story. I didn't message me.
Yeah.
And I should have kept going.
Because it was WhatsApp.
And it would have been like Telegram today.
Telegram today.
Yeah.
Did you guys have encryption in there, or it was?
We did. It was part of our roadmap. What's funny is Yahoo bought MessageMe, the team, but the assets I owned, and so a lot of it actually moved over to the Telegram guys.
Wow, it's amazing. I get that a lot with Weblog Sync. People are like, "Oh, you sold that too early." I was like, "I was broke. I was negative 10,000. I was engaged to Jade, and I was negative 10,000 when they bought it. We had $100K in revenue. They offered $30 million.
Yeah."
We had $100,000 to date in Web 2.0. $30 million was a huge acquisition in 2005.
It's huge.
Flickr went for 25.
Yeah, massive.
Delicious went for 20.
Yeah.
We went for 30. And I think Blogger went for 50 or 60. And then eventually that equity in Google became worth a lot more.
Yep.
But yeah, how do you manage that when to sell when you're talking to founders?
I just tell them you'll know when's the right time to sell or not. I was just like, as being a founder before, I had numerous acquisition offers at higher prices, and I didn't take them because I had hubris, and I was like, I'm just gonna go take over the world.
Tree's gonna go to the moon.
And it didn't work out. So you're talking about hundreds of millions of dollars lost on the table. That's okay.
So that's why you sold early. Yeah, that does happen. I the reason I sold early with Weblogs Inc., but it was fine because if we had stuck around, we might have been able to grow at 3x where it went in 10 years. So it was fine. But I had been offered $20 million for Silicon Valley Reporter, and I didn't take it. And I just kicked myself for years that I was an idiot for not taking it. So I did a snap. But you didn't have, with MessageMe at that time, the ability to do a secondary with your VCs and have them buy half your shares or a third of them?
We did. For our Series A, we did.
You did?
And we didn't take it.
Oh.
And then we also had 2 acquisition offers above 150 million. We did not take it. So it's a hard thing. It's okay.
Yeah, you know what? One of the things is, living with regret when you're in the greatest industry ever at this incredible moment of time. It's another thing you have to unlearn. Like these kind of mistakes, these all add up to, you're 35 now, I'm 47. Like, got a lot of life in front of us.
A lot.
You can really take those lessons and you have plenty of time to incorporate them into a win later. LeBron lost all those championships and the finals to Dallas, the finals to this team, to that team. I mean, LeBron just poured in the losing early in his career. He got to the finals, got to the playoffs easily, and he just kept losing. Michael Jordan too, but you build up that scar tissue. But the secondary shares makes it so easy to keep going. I had one company that you guys made an offer on for the Series A, and I remember you called me, like, why didn't we get the Series A? You didn't call me, but one of the people who worked for you, like, we need some feedback on this. We wouldn't say the name of the
I know
company.
which one you're talking about.
Yeah, and I talked to the founder. I'm like, what's going on? And he's like, we're selling.
Yep.
And I was like, oh my God, no. And he says, you're going to make $1 million. And I said, that is my nightmare. This is 100x from here. The company that's buying you for $30 or $40 million is going to grow it 10 to 100x from here. Do not sell. Let's set up secondary. How much money do you need? Sell half your shares, sell 30 of your shares. Let's get a syndicate together. And they just...
Yeah, it's hard to foresee. I would never fault a founder for doing it. And I've told multiple founders that if you want to do it, I'll support you 100%. So
I'm the opposite now. I fault them for it.
Yeah.
I'll tell you why I fault them for it. I have now in my later years realized that a lot of times there is this unique opportunity that may not come along. And the ability to take the idiot insurance, just get that $2, $4, $6 million to buy your loft and sell some portion of your shares. It's available now, and it never was when we were coming up as entrepreneurs.
I agree with that.
You caught it a little bit, but before, when that happened,
we didn't catch it for 2007, 2008 timeframe.
Yeah, it didn't become de rigueur until 2011, 12 that people after Facebook did it.
Correct.
And Zynga did it. It was like, okay, this is legit. It turned out okay. The founder didn't lose their mind selling a couple of shares in secondary, which was the fear. And when people first started selling secondary, Fred Wilson, Ron Conway, a bunch of people were like, this is a terrible precedent. we have to stop this. I think, and we can look up the blogs, but I think they were kind of really nervous as well because
I think it was almost 90% of people categorically didn't like it, and the reason was they were investing at the early stages, and they didn't get to sell during those stages and have their returns, and they considered it unfair. I actually consider it unfair that investors would say that, and I would say that till death today. Is that investors have a portfolio, and founders is just that one company.
Right.
So if you do want
hypocritical.
You want their mind to be in it for the long haul. So the secondary that they do get, you want to make sure it's not a crazy amount, but it's something that allows them to live properly.
I have a pretty easy rule about this. If it's enough money for them to buy a plane or even one of those Jet Suite cards or whatever, no. If it's enough to buy a loft or a house in San Francisco, Bay Area, yes. So 3, 4, 5 million, 6 million, 7 million, okay. But once you get above 20 million, 30 million, now the person starts thinking about a plane. They start thinking about the third home. And now all of a sudden you got to have a home manager, and now they're just completely disengaged from the business. They're trying to figure out how to spend that money or not lose it.
You don't think like that, right?
No. I'm a blue-collar kid from Brooklyn. Honestly, I think one of the things in life that's very important is remember where you came from and not get ahead of your skis. The people who are truly happy, and I think Naval mentioned this or he retweeted somebody, people who live well below their means are so much happier in life.
Much happier.
I sleep so well not having to worry about second and third and fourth homes like some of my friends or planes or nonsense. Just sleep. Go to sleep. And the hamburger that I ate when I was broke and the hamburger I can eat now when I'm rich, it's no different.
It's great. It still tastes great.
Still great hamburger. And there's no hamburger.
But now you can just order on Postmates.
That's the other thing. I would never do that. But I was explaining this to a mutual friend of ours who was ordering Postmates all the time. I said, you understand that costs like $15? He's like, no, it's all included. I'm like, I think you need to read the receipts. You're paying $15 to get $15 hamburger delivered.
Yeah, it's a lot.
Be careful. All right, listen, Arjun, thank you for doing this.
Thank you for having me.
I was trying to wrap up. I'm sorry, award-winning producer Jack. I tried to wrap up, and then we got into the pivot and the secondary. So much good information, and that's really why we do these podcasts. If you like the podcast, and if you ever want to reach me, I'm jason@calacanis.com, which is my email, first name at last name, and do buy the book. If you made it to this point in the podcast, you obviously are a fan of this podcast and what we're doing here. Buy the book so I can write another one, and I want to write the next one, so I'm trying to get the sales there. It's doing well, it's selling. We sold tens of thousands of copies. This book is great.
I'm sure it is. I like the cover.
You didn't see the alternate covers. There were 2 other covers, literally, that I'll release in the next book. I'll release the covers to this one, which led to hilarity at the poker game and everything, it was a picture of me as an archangel with a sword and a spear with my chest, like chiseled like a romance novel, like a scepter flying through the air, and like my face photoshopped onto it. It looked terrible.
You should have just A/B tested it, see which one worked better.
The problem was it didn't look good. It was like poorly done illustration, didn't look great. But I was like, this is so insane that it will get people talking.
Yeah.
And I didn't do it. In some ways I regret it, but in other ways I think it's the right move.
Next time.
Next time I will do a shirtless, archangel out there. All right. We'll see you all next time on Angel Podcast. Thank you.